A crypto bull cycle is a period of sustained, significant price increases across the digital asset market. Think of it as a tidal wave of optimism and buying pressure. Investors, both retail and institutional, become increasingly confident. They pour capital into Bitcoin and other cryptocurrencies. This isn't just a small uptick, it's a powerful market-wide surge that can last for months or even years. People are incredibly excited right now, in May 2025, because we are deep in one such cycle. Fortunes are being made. The energy is infectious. It feels like a modern-day gold rush, and everyone is eager to stake their claim in this digital frontier. The current excitement in 2025 stems from a potent combination of factors that built up through 2024. After a period of consolidation, often referred to as a crypto winter or a quieter accumulation phase, the market has roared back to life. Fresh narratives around groundbreaking technologies and new use cases are capturing imaginations. Significant capital, previously sitting on the sidelines, is now flowing in. Both everyday investors and large financial institutions are waking up to the potential they might be missing. The fear of missing out, or FOMO, is a powerful psychological driver, and it's currently fueling the market's ascent. This isn't just speculative mania. The underlying fundamentals of leading crypto projects are arguably stronger than ever before, adding substance to the excitement. Historically, the crypto market has moved in distinct cycles. We witnessed major bull runs in 2013, 2017, and again in 2020 to 2021. Each of these cycles brought cryptocurrencies further into the mainstream consciousness, and each peak was significantly higher than the last. Certain patterns tend to emerge during these periods, offering lessons for those who study them. However, it's crucial to remember that while history provides context, each bull cycle possesses unique catalysts and characteristics. The current run is no exception. Understanding this cyclical nature and the specific drivers of today's market provides invaluable perspective for anyone looking to navigate this space. It helps differentiate signal from noise. The psychological component of a bull market cannot be overstated. These periods are overwhelmingly dominated by greed and extreme optimism, often overshadowing fear and caution. The mainstream media picks up on the rising prices, amplifying the excitement and drawing in new participants. Social media platforms buzz with success stories and bold predictions, further fanning the flames. While it's vital for investors to remain grounded and analytical, the power of collective belief in a market can, to some extent, become a self-fulfilling prophecy. As more people believe prices will rise, they buy, which in turn pushes prices higher. The crowd's momentum is a formidable force in these digital asset markets. The year 2024 was absolutely pivotal for the cryptocurrency market. It laid the crucial groundwork for the explosive bull run we are experiencing now in 2025. Several immensely powerful factors converged, creating what many describe as a perfect storm for price appreciation across the asset class. It wasn't attributable to a single event, but rather a synergistic combination of developments that collectively shifted market sentiment from cautious to wildly bullish. This confluence of positive triggers was potent, and astute investors began to take notice early, positioning themselves for the surge that followed. The seeds of this bull market were sown throughout last year. The Bitcoin halving in April 2024 stands out as a primary and highly anticipated driver. This event, which occurs approximately every 4 years, is a programmatic supply shock hard-coded into Bitcoin's protocol. It cuts the rate at which new Bitcoins are created and distributed to miners by 50%. Historically, halvings have been followed by significant bullish price action, as the reduction in new supply meets steady or increasing demand. Anticipation for this event built steadily throughout 2023 and early 2024, drawing attention to Bitcoin's fundamental scarcity. This is a core tenet of Bitcoin's value proposition. Fewer new coins entering circulation inherently makes the existing ones more valuable over time. Another monumental shift in 2024 was the undeniable arrival of institutional money into the crypto space, and on a scale previously unseen. Major financial players, including prestigious hedge funds, global asset managers, and even some conservative pension funds, began to make significant allocations to Bitcoin and other digital assets. This influx not only brought substantial new capital into the market, but also served as a powerful validation of cryptocurrencies as a legitimate and investable asset class. Their participation signaled to the broader financial world that crypto is here to stay and has serious long-term potential. This wasn't just retail speculation anymore. The smart money was making its move. Perhaps the most talked about catalyst of 2024 was the approval of spot Bitcoin exchange-traded funds, or ETFs, in the United States by the Securities and Exchange Commission. This was a genuine game changer. These financial products allow traditional investors to gain exposure to Bitcoin easily through their existing brokerage accounts, without the need to navigate crypto exchanges or manage private keys. This regulatory green light, after years of anticipation and rejections, effectively opened the floodgates for a torrent of capital. It was a monumental step in bridging the gap between traditional finance and the digital asset economy, removing significant barriers to entry for millions of potential investors and truly pushing Bitcoin investment into the mainstream. Let's delve deeper into the Bitcoin halving, a truly unique and fundamental aspect of its design. This event is pre-programmed into Bitcoin's code to occur every 210,000 blocks, which translates to roughly every 4 years. When a halving takes place, the reward that Bitcoin miners receive for verifying transactions and adding new blocks to the blockchain is cut precisely in half. For instance, the April 2024 halving reduced the block reward from 6.25 BTC to 3.125 BTC. This mechanism is automatic, unchangeable by any central authority, and perfectly predictable. It's this predictable scarcity that forms a cornerstone of Bitcoin's appeal as a store of value, often earning it the nickname digital gold. The direct impact of the halving is on Bitcoin's supply dynamics and its inflation rate. By reducing the creation of new Bitcoins, the halving effectively slows down the rate at which the total supply of Bitcoin increases. This decreasing inflation rate means that Bitcoin becomes progressively scarcer over time. In fact, its issuance schedule is designed to be disinflationary, eventually leading to a fixed supply of 21 million coins. Basic economics dictates that if the supply of an asset is reduced while demand remains constant or, even better, increases, the price of that asset should rise. This fundamental principle is well understood by investors and is a key driver of the bullish sentiment surrounding halving events. Looking at historical performance provides compelling, though not definitive, evidence. The previous Bitcoin halvings in November 2012, July 2016, and May 2020 were each followed by periods of extraordinary price rallies, often starting some months after the event and lasting for over a year. While it's always emphasized that past performance is not a guarantee of future results, these historical precedents create strong expectations within the market. Traders and investors anticipate this effect, often leading to increased buying pressure both before and after the halving itself. This pattern of post-halving bull runs is a powerful narrative that is difficult for the market to ignore. The 2024 halving was particularly significant due to the context in which it occurred. The cryptocurrency market had matured considerably since the previous halving in 2020. There was far greater global awareness of Bitcoin, and importantly, this halving coincided with other major bullish catalysts, most notably the launch of spot Bitcoin ETFs. This meant that the programmed supply shock hit a market that was already primed for growth, with new avenues for demand opening up. The combination amplified the typical halving effect, creating an exceptionally potent mix for the upward price momentum that has characterized late 2024 and much of 2025 so far. It was a supply crunch meeting a demand surge. The approval and launch of spot Bitcoin ETFs in the United States in early 2024 was nothing short of a landmark achievement for the crypto industry. These financial instruments fundamentally changed the game for Bitcoin accessibility. For the first time, ordinary investors, financial advisors, and even large institutions could gain direct exposure to the price of Bitcoin through highly regulated, traditional investment vehicles listed on major stock exchanges. This meant no more navigating the complexities of cryptocurrency exchanges, self-custody, or private key management if one didn't want to. The process of investing in Bitcoin became as simple as buying a stock, dramatically lowering friction and broadening its appeal. The immediate impact of these ETF launches was staggering, far exceeding many optimistic projections. Billions upon billions of dollars flowed into these new products within weeks and months of their debut. We witnessed record-breaking inflows for newly launched ETFs, clearly demonstrating the immense pent-up demand from the traditional finance sector. This wasn't just retail money. A significant portion of this capital injection came from institutional investors who had been waiting for a regulated and familiar way to allocate to Bitcoin. The sheer volume of these inflows provided a major and sustained boost to Bitcoin's price throughout 2024 and into 2025, proving strong institutional conviction. The role of government regulation, specifically the US Securities and Exchange Commission, was absolutely crucial in this development. The journey to ETF approval was a long and arduous one, marked by numerous proposals, rejections, and intense debate over several years. The eventual green light, even if specific to Bitcoin and under particular interpretations of existing securities laws, signaled a significant, albeit cautious shift in the regulatory stance towards digital assets. It provided a much-needed regulated pathway for investment, which is paramount for conservative institutional capital and financial advisors who operate under strict compliance mandates. This legitimacy is key for attracting more substantial, long-term investment. However, the broader regulatory landscape for other crypto assets remains a work in progress. Looking ahead, the success of Bitcoin ETFs has paved the way for what many see as the next logical step: spot Ethereum ETFs. Applications are in, and the market is buzzing with anticipation for potential approvals later in 2025 or early 2026. If approved, this would further solidify institutional adoption and could unlock similar inflows for the second-largest cryptocurrency. Beyond Ethereum, the precedent set by Bitcoin ETFs could eventually lead to regulated investment products for other select crypto assets, further bridging the gap between traditional finance and the burgeoning digital asset economy. This is clearly just the beginning of a much larger trend of regulated crypto products becoming mainstream. Naturally, Bitcoin continues to lead the charge in this 2025 bull market. It remains the undisputed king of cryptocurrencies, the original digital asset that started it all. Its sheer market capitalization and brand recognition mean that its price movements often exert a gravitational pull on the entire crypto ecosystem. Bitcoin is benefiting massively from the institutional adoption spurred by ETFs and the ongoing effects of its 2024 halving. The narrative of Bitcoin as digital gold, a reliable store of value and an inflation hedge, is strengthening daily, especially in the current macroeconomic climate. It's considered the bedrock of the crypto world, and its performance is a key indicator for the health of the broader market. Ethereum is firmly holding its position as the second most dominant force and the leading smart contract platform. The anticipation surrounding potential spot Ethereum ETF approvals is a major narrative driving interest and investment into ETH. Beyond ETFs, Ethereum's vibrant ecosystem continues to expand with innovations in decentralized finance, non-fungible tokens, and the crucial development of Layer 2 scaling solutions designed to make the network faster and cheaper to use. The vision of Ethereum as a world computer, a decentralized platform for a new generation of applications, is continuously evolving and gaining traction. Its vast utility and developer activity are fundamental drivers of its long-term value proposition. Beyond the two giants, several emerging trends are capturing significant attention and capital in 2025. The tokenization of real-world assets is a particularly hot sector, aiming to bring traditional assets like real estate, bonds, and art onto the blockchain, unlocking liquidity and efficiency. The intersection of artificial intelligence and cryptocurrency is another explosive area. with projects exploring decentralized AI marketplaces, AI-powered trading bots, and data verification. DePIN, or decentralized physical infrastructure networks, which use tokens to incentivize the build-out of real-world infrastructure like wireless networks or energy grids, is also gaining momentum. And of course, blockchain gaming, or GameFi, continues to attract users and investment with its play-to-earn models. When looking at other promising altcoins and Layer 1 blockchains, Solana stands out due to its high transaction speeds, low fees, and rapidly growing ecosystem of decentralized applications. It has positioned itself as a strong competitor to Ethereum. Layer 2 solutions built on top of Ethereum, such as Arbitrum and Optimism, are also crucial for scaling the network and are seeing increased adoption. Many other innovative projects are vying for attention, each with unique value propositions. As always, it is paramount for investors to conduct thorough due diligence, focusing on a project's underlying technology, its team, community engagement, and genuine utility before considering an investment. The altcoin market is incredibly dynamic, offering both great opportunity and significant risk. The most obvious opportunity presented by a crypto bull market is the potential for significant wealth creation. We are in a period where life-changing financial gains are genuinely possible, though certainly not guaranteed for everyone. Investors who positioned themselves wisely in promising projects are already seeing substantial returns on their capital. The allure of these high returns is a powerful magnet, drawing in new participants from all walks of life. This motivation to grow wealth fuels much of the market's energy and momentum. The numbers can indeed be staggering, but achieving such results requires careful navigation, research, and risk management. Beyond just chasing price pumps, a bull market offers incredible diversification opportunities. While Bitcoin and Ethereum are often the primary entry points, the crypto space is vast and quite varied. Investors can gain exposure to new technologies, innovative sectors, and emerging narratives. This includes areas like decentralized finance, or DeFi, non-fungible tokens, metaverse platforms, decentralized autonomous organizations, and real-world asset tokenization. Spreading investments across different crypto assets can help mitigate risk while capturing upside from various fast-growing market segments. A well-balanced crypto portfolio can often outperform one heavily concentrated in a single asset. There's also a unique opportunity to actively participate in groundbreaking innovation. Investing in crypto isn't just about speculation, it's about backing projects building the future of finance, Web3, and digital ownership. By investing in tokens, individuals contribute to decentralized networks and communities that solve real-world problems. This aspect of being part of a technological revolution offers non-monetary rewards beyond financial gains. It's a chance to be an early adopter in a transformative industry. In terms of investment strategy, bull markets cater to long-term holders, hodlers, and more active traders. Hodling is a strategy for those with strong conviction in the long-term value of specific cryptocurrencies. Active trading involves capitalizing on short to medium-term price movements. Bull markets offer ample opportunities for skilled traders. It's crucial for each investor to understand their risk tolerance, time horizon, and financial goals to determine the most suitable approach. Both can be profitable with discipline and a clear plan. While the allure of soaring prices is strong, it's absolutely critical to acknowledge that extreme volatility is an inherent characteristic of the cryptocurrency markets, even during powerful bull runs. Prices can, and often do, experience wild swings in very short periods. Sharp corrections of 20, 30, or even more % are not uncommon and can occur with little warning, shaking out less experienced or overly leveraged investors. It is paramount to be mentally and financially prepared for this roller coaster ride. Panicking and selling during these dips is often a recipe for losses. Cultivating emotional discipline and a long-term perspective is crucial for navigating these turbulent waters successfully. This isn't a smooth, straight line upwards. The heightened excitement and influx of new investors during bull markets unfortunately create a fertile ground for scams, hacks, and rug pulls. Bad actors are always looking for ways to exploit the enthusiasm and greed that permeate these periods. investors may encounter fraudulent projects promising unrealistic returns, phishing attempts designed to steal private keys, or projects where developers suddenly disappear with investor funds. Conducting thorough due diligence on any project before investing is absolutely essential. Remember the age-old adage, if it sounds too good to be true, it probably is. Protecting your digital assets through strong security practices is non-negotiable. Regulatory uncertainty also remains a significant factor and a potential risk in the crypto space. While the approval of spot Bitcoin ETFs was a positive step towards regulatory clarity, the broader global regulatory framework is still evolving and varies widely between jurisdictions. Governments around the world are grappling with this new asset class, and policy changes or crackdowns in certain countries can have a swift impact on market sentiment and prices. Staying informed about the evolving regulatory landscape is crucial for any serious crypto investor. Finally, there's the ever-present risk of buying the top, especially when driven by FOMO. As prices reach euphoric highs and mainstream media coverage becomes incessant, it's easy to get caught up in the hype and invest at inopportune moments, just before a major correction. Understanding market cycles, recognizing signs of overextension, and not investing more than you can afford to lose are fundamental principles of risk management. Implementing profit-taking strategies as prices rise can also be a wise approach. No market goes up in a straight line forever, and corrections are a natural part of any market cycle. For anyone new to the crypto space, especially during the excitement of a bull run, the absolute first step must be education. Before investing a single dollar, take the time to understand the fundamental concepts: what blockchain technology is, how Bitcoin works, the differences between various types of cryptocurrencies, and the specific use case or value proposition of any asset you are considering. Don't invest based on hype, a friend's tip, or a social media post alone. Knowledge is genuinely your best defense against making costly mistakes in this complex and rapidly evolving market. Thankfully, there is a wealth of high-quality free educational resources available online, from articles and videos to podcasts and online courses. Dedicate serious time to learning. Once you have a foundational understanding, it's prudent to begin your investment journey with a small amount of capital. Only invest money that you can genuinely afford to lose entirely without it impacting your financial stability or well-being. Cryptocurrencies are considered high-risk, high-reward assets, and their prices can be extremely volatile. Avoid the temptation to go all in right away, especially if you are new. It's much wiser to test the waters, gain some practical experience with buying, selling, and securing crypto using a smaller sum. This approach helps you learn the ropes and reduces the potential for significant financial pain if the market takes an unexpected downturn or if you make beginner errors. Choosing reputable and secure platforms for buying, selling, and storing your crypto is paramount. Opt for well-established cryptocurrency exchanges that have a strong track record for security, transparency, and regulatory compliance. Always enable two-factor authentication, 2FA, on your exchange accounts and use strong, unique passwords. For holding cryptocurrencies long-term, especially larger amounts, seriously consider using a hardware wallet. These physical devices keep your private keys offline, providing a much higher level of security against online hacks and theft. Remember the crypto mantra, not your keys, not your crypto. Understanding the basics of self-custody, even if you start with an exchange, is incredibly important. Finally, it's highly beneficial to develop a clear investment strategy and then make a concerted effort to stick to it. For many beginners and even experienced investors, dollar-cost averaging, DCA, can be a very effective approach. This involves investing a fixed amount of money at regular intervals, regardless of the price, which can help smooth out the impact of volatility over time. Set realistic financial goals for your crypto investments and try to avoid making emotional decisions driven by the fear of missing out during market pumps or panic during price dips. Patience is very often rewarded in the cryptocurrency market. Adopting a long-term perspective can help you weather the inevitable storms and stay focused on your goals. Looking ahead to 2026, one of the most confident predictions is the continued and deepening institutional adoption of cryptocurrencies. The barriers that once kept large financial players on the sidelines are steadily crumbling. We anticipate the launch of even more sophisticated and diverse crypto-based financial products, catering to the needs of institutional clients. This could include more ETFs beyond Bitcoin and potentially Ethereum, as well as structured products, derivatives, and fund of funds. Expect to see pension funds, university endowments, and corporate treasuries increasingly allocating a portion of their portfolios to digital assets, recognizing their potential for diversification and growth. The wall of institutional money entering the space will likely continue to grow substantially. Regarding Bitcoin's price, the sky truly seems to be the limit in the eyes of many seasoned analysts and proponents, especially as we look towards the potential peak of the current bull cycle, which could extend into 2026. Numerous forecasters are eyeing price targets well above $100,000 per Bitcoin, with some even suggesting figures in the $250,000 to $500,000 range or higher during this cycle's zenith. Of course, these are speculative predictions and depend heavily on sustained institutional inflows, favorable macroeconomic conditions, and continued positive sentiment. However, the underlying narrative of Bitcoin as digital gold and a superior store of value is expected to strengthen, underpinning these optimistic price outlooks. We also foresee a significant maturation of Web3 technologies and the decentralized finance ecosystem by 2026. The focus will increasingly shift from speculation towards demonstrating greater real-world utility and solving tangible problems. Blockchain technology is likely to become more seamlessly integrated into a wider array of traditional industries, from supply chain management and healthcare to intellectual property rights and voting systems. We anticipate mainstream adoption of user-friendly decentralized applications that abstract away much of the underlying blockchain complexity. This technological maturation and improved user experience will be key to unlocking new use cases, attracting a broader user base, and fostering sustainable long-term growth for the entire ecosystem. Finally, regulatory clarity for the crypto industry is expected to improve globally by 2026. While the path may not be entirely smooth or uniform across all jurisdictions, the trend is towards establishing clearer legal and regulatory frameworks. This increased clarity, even if it means more rules, will ultimately be beneficial for the industry by reducing uncertainty, protecting consumers and investors, and fostering legitimate innovation. We may also see some consolidation in the market, with stronger, well-managed projects thriving and weaker ones fading away. The crypto landscape in 2026 will likely look more mature, more professionalized, and more deeply integrated with the traditional global economy, paving the way for the next phase of growth.